Hello, I'm John Prasinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, January 11. Before I get to the markets, please indulge me as I express a quick personal note. During Ronald Reagan's second term, I worked on Capitol Hill as a press secretary to a member of the House of Representatives. These days, it's fashionable to be cynical about politics, to make snide comments about our elected officials. I'm sometimes guilty of the practice myself. But the fact is, we live in the greatest democracy the world has ever known. A system of checks and balances crafted by geniuses who are products of the 18th century Enlightenment. I'm proud of my stint as a congressional staffer. And despite our country's myriad flaws, I'm also proud to be an American. Look, it's not my job as editorial director to get overtly political, but all human relationships, in a sense, are political. Human politics and the art of compromise pervade our everyday lives, and they certainly affect Wall Street. What we witnessed last week, a feral mob ransacking the halls of Congress, a place where I used to work, was an utter disgrace, and it chilled me to the bone. The people's house was desecrated by thugs. I don't care whether you're a Republican or a Democrat. Every patriotic American should be appalled by what we saw. If the great American experiment is to survive, the guilty parties must be brought to justice to set an example and to help ensure it never happens again. Let's do the numbers. Stock markets witnessed a strong start to the year, with major indices in the U.S. and overseas last week reaching fresh record highs. Small cap and international stocks outperformed, reflecting optimism largely fueled by coronavirus vaccine rollouts. Underscoring bullish sentiment, crude oil prices climbed above $50 per barrel as OPEC's de facto leader, Saudi Arabia, announced an unexpected production cut. The following table tells the story. I'm generally bullish about investment prospects in 2021, but stocks are getting pricey, and the coronavirus pandemic isn't behind us. We'll probably experience a few sell-offs along the way. During these sell-offs, should you buy on the dips? It depends, of course, on the industry. Certain sectors are poised to thrive despite the pandemic, but other industries will take a long time to get back on their feet, and you should continue to remain wary of them. There's a Wall Street saying, never try to catch a falling knife. A falling investment could rebound, or it could lose more value. Trying to predict the bottom is like grabbing a knife on its way down. Pain usually ensues. When it comes to the economy, there's still plenty of pain to go around. The Labor Department on Friday released a disappointing employment report that showed a loss of 140,000 jobs in December instead of the expected gain of 50,000 jobs. This marked the first time employment growth has been negative since April, a sign that the recent resurgence of the coronavirus is again undermining the economy. ADP reported on Wednesday that private payrolls declined by 123,000 jobs in December compared to the consensus estimate for a gain of 60,000 jobs. The drop reversed 7 consecutive months of growth. See my second chart. According to ADP estimates, companies laid off a net 19.4 million workers in April and have since recovered 9.9 million. Leisure and hospitality have endured the worst job losses. Several industries have been clobbered by the coronavirus pandemic, but few as severely as tourism, leisure, and hospitality. I've frequently written about the economic winners during the pandemic. However, some industries will take a long time to bounce back, and it would be a mistake to seek value plays among them. They're really value traps. Tourism is one such victim, and it's a case study as to how some industries have been severely hobbled for the long term. The World Tourism Organization, UNWTO, reported that it expects international arrivals to have declined by 70% to 75% in 2020 compared to the previous year. That represents a decline of about 1 billion international arrivals, bringing the industry back to 1990 levels. See my third chart. The experts at UNWTO don't expect a full recovery of tourism in 2021, which began with a deadly resurgence of the coronavirus. According to the UNWTO's estimates, it will take the industry between 2.5 and 4 years to return to pre-pandemic levels of international tourist arrivals. Tourism, leisure, and hospitality stocks are down, and for good reason. Should you go bargain hunting? I think you should stay away. The risks haven't abated, not by a long shot. A better place to put your money is the marijuana sector. Now that the Democrats control the Senate, the lifting of the federal ban on cannabis Well, it's a slam dunk, take it from me. Pot stocks are poised to soar. In fact, if long-term political history is any guide, the stock market rally should continue this year. Generally, the stock market has performed well in the year after a presidential election, posting an average return of 10.2%. When a Democratic president took office to succeed a Republican White House, the average stock market return in the following year was 14.1%. When an election put the same political party in control of the White House in both chambers of Congress, the average return the next year was 11.8%. Well, that's it for now. If you want to reach me, just send an email to mailbag@investingdaily.com. Thanks for watching.